Good morning, hello and welcome to a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal studios. I'm Prashant, with me, my colleagues Sonia and Nigel. Guys, hi, good morning.
Good morning.
Hi, good morning. This week has flown by. I mean, it was just like, I guess, a few hours ago we were talking about Monday and now we're here on Thursday, right? So, but I guess for the bulls, not so much because it's been sort of a heavy week where the bulls have been pretty much on the back foot. But, you know, if you look at what's been happening so far, the bears have been in complete control of this market. So just a couple of things that I want to point out as we kickstart trade. It's been, what, the fourth straight day of losses. So I guess that's something that would irk a lot of people on the street.
You know, 4 days, Sonia and Nigel, the Nifty has lost 600 points. The Bank Nifty is down 1,300 points, right? So it's been fast and furious in the coming. And that kind of, at the margin, raises the hope that can this continue without a new, fresh trigger at the same pace down? I think not. And we'll talk more about that. But let's just start with the beginning, right? The very beginning in terms of what the cues from overnight are. So you've got US stocks which actually closed absolutely flat. This is after the 2% fall that we had on Tuesday. The close is on your screen, the S&P and the Nasdaq. The Nasdaq actually was up a little bit. The S&P was still down. I'm not getting into the intraday moves. I mean, the market was up at one point, then it lost after the FOMC minutes. That's besides the point. The close was flat. The FOMC minutes reinforced Fed's hawkish commitment. This is the data point which many were wanting to watch, despite knowing fully well the minutes for which the meetings, the meeting for which the minutes were released yesterday happened before the string of strong data. You know, the jobs number and the CPI number and the PPI number and the services PMI, etc. So this is kind of pre all the strong data points. But in any case, even then, you know, there were hawkish edits to an otherwise, I would say, stale minutes. And the hawkish edit is simply the fact that the minutes did not discuss a pause, right? And I think this is something which lends that hawkish kind of tinge to the entire meeting minutes. So no help from there, really. Let's put it that way. The 10-year closed flat. I mean, it almost got to the 4% mark, 3.97 it is where it got to, and finally left off at about 3.92. Day on day, it was flat. The dollar index is still, though, higher at about 104.4, 104.5. So this is stronger. The dollar is not really pulling back, and expectations are growing with the positioning in the dollar cleaned out. People were more willing to go short the dollar, but that's kind of, you know, reverse. And maybe the dollar strengthens a little bit. You've got to look at the dollar, the euro dollar cross or the JPY dollar cross, and the dollar is looking stronger against some of the major ones. All right, let's get to the market here, right? As I said, the Nifty has lost 600 points in the last 4 sessions, and the Bank Nifty is down 1,300 points in the last 4 sessions as well. So you add to the mix the fact that, you know, yesterday, for example, we did not have very large, and actually this is not just true yesterday, but the last 2 days, the sell flow numbers from FIIs, etc., has not been, institutions has not been humongous. I mean, so the fall is not supported or is not borne through by very large institutional sell flows. So with that said, what are we watching out for? I would still kind of put out the downside numbers first. We are watching the 17,585 level on the Nifty. We'll put out a chart to this effect in a little bit from now. If you join the level from the lows of June, 17th of June 2022, when that big correction happened and the big rally, it meets straight up to the low of the 1st of February 2023, which is the day of the budget, and you extend it through, it meets the Nifty at 17,585. We left off yesterday at 17,554, which is slightly under it, 30 points under it. So that becomes a important pivotal kind of level. The budget day low has again, unfortunately, come back into focus, but I think that's the big one to watch. 17,353 is in that sense, the big support to watch. I mean, beyond that, then you get into looking at sort of, you know, longer term 20 weekly moving averages and things like that. I think we have the chart which may kind of make that point. This is what I put out yesterday on the Nifty. From the lows of June 17, 22, 1st of Feb 2023, and it meets the Nifty at 17,585. So that's the level in the very near term around which the market is closed. It becomes important. On the Bank Nifty, it closed below the 61.8%, the golden retracement of the entire rise, right? The big support for the Bank Nifty comes in at 39,420. We left off yesterday at about 39,995. upside levels, I think we can kind of, start to pencil as the market shows a little bit of enthusiasm, but the structure is weakened quite a bit. And I think bears are feeling more confident that when, and you could have seen that all day yesterday, day before yesterday, 30, 40-point bounces, which were getting easily sold into. And I think that tells you that maybe for the time being, things perhaps remain a little down and out. But will we continue with the pace of fall that we've seen over the last 4 sessions? I would say it should moderate a little bit. Guys, hi.
That was our question, right, over the last many days, and which way will the range break?
Yeah.
And now it seems like the range could break on the downside. At least that's the trend we've gotten over the last couple of days. 4 straight days of losses, as we've been telling you. And on the Bank Nifty, this year already, the Bank Nifty is down about 7%. But if you map it from the highs that we saw in December, the Bank Nifty is down 9% from December highs. So this definitely, that whole piece has broken down and is not giving any support to the bulls. FIs as well sold almost 600 crores in the cash markets yesterday. So once again, the FI numbers are rising. And the Nifty is now testing the 200-day moving average of 17,349. So that's the level I'm watching very closely on the downside. Now, of course, Prashant was talking about how the Fed's peak was a bit on the hawkish side. They've showed a resolve to fight inflation with rate hikes, and a few officials are also talking about a 50 basis points rate hike. So that's kept a lid on the market gains. You've seen a big fall in crude, Brent crude overnight as well. Now, a couple of things to watch out for today. One, of course, it's FNO expiry, and the bias has been on the short side, on the sell side. So that weakness could shape up today as well. There's a lot of global data coming through, especially from the US markets, whether it's the US GDP data, the weekly jobless claims that's due. You have a lot of earnings coming through from the likes of Alibaba, Bath and Body Works, Papa John's, etc. in the US. So, the consumer story has been weakening there. We saw it with Walmart and Home Depot. So these numbers will also assume importance. But give and take everything, it looks like the bears have tightened their grip on the market now, and that's not going anywhere, at least in the near term.
Well, that's right, Sonia. In a weak global cues, you have expiry as well that will play out, and the rolls are not very, very high. So today, expecting a fair bit of volatility, particularly in the second half of trade. So that's the picture as we speak. And yesterday, the problem was the key technical levels did break out. That 17,750, it broke in the first hour itself. And yesterday was a perfect day where you understand the importance of a stop loss. Because at 17,720 to 17,750, once that level broke, any kind of bounce was getting sold into. Now, we're due for a bit of a relief rally, though it's unlikely to be long-lasting. And maybe in the near term, we're a bit oversold. Now, the Nifty looks vulnerable till that 17,850 to around, 18,000 odd mark, till we get past that band. The bulls will feel good if we get past today without breaking that 17,500. And that's what positioning is showing. What do the FIs do in the FNO market? Well, yesterday, getting into expiry day, they added 40,000 short contracts. That's 4 shorts for every 1 long position, and that's perfectly how the setup has been, because the shorts are at around 77% or thereabouts. They also wrote calls. They wrote calls aggressively. 1.4 lakh calls is what's written. So they're shorting the index and they're writing calls as well. Now, the PCR has moved to sub that 0.7 odd. Normally, we have seen a bit of a bounce in that 0.65 to around 0.7 odd. And that's because yesterday, just take a look at the call writing. Getting into expiry day, you have more than 1 crore shares written at around 17,700 and 700 odd. So we're not unlikely to see that level. 17,600 though, there's a lot of confidence out there that the bears are showing, because they believe that 17,650 level will hold out. So that's why there's aggressive writing out there. While on the downside, 17,500 put, well, that did see some bit of writing. So just plugging in those numbers, because some bit of writing was seen at around that 17,500, that could be the final frontier actually for the bulls. They're hoping that the 17,450 odd level holds out. The call writing we saw, so that's why resistance at around 17,650. And the bulls definitely don't want to see the lows that we saw on budget day, but that as well comes up for you on the screen. We're likely to open up with a gain of around 50 points. That will likely to get sold into, but hopefully we don't break 17,500 odd mark. Maybe a couple of positives that could play out. One is the IT index, because the Nasdaq stabilized overnight, and Brent crude prices down $6 in the last week or so.
All right, Nigel, thanks very much for that. So that's the cues as we are seeing it as we start another session. Well, before we go any further, let's quickly tell you what is lined up here in the first half hour of the show. We get you updates from markets across the globe. Jahangir Aziz of JP Morgan, Rupal Agarwal of Bernstein join in to discuss the global trade setup. Our research team brings you CNBC-TV18's list of top 10 stocks to watch. At 8:30, we talk markets with Aditya Suresh of Macquarie.
Okay, this morning we have two market views coming up for you. First one is from Vikas Jain of CLSA, who says their analysts have upgraded revenue forecasts for FY24 and FY25 by a small 2 to 3%, but have cut the EBITDA margins by 40 to 30 basis points. He says all the sectors saw an EBITDA margin contraction except IT and staples. He also says Nifty consensus EPS was cut by 0.9 to 1.5% for FY23, 24 and 25. He stays cautious and they have adjusted weights in their India portfolio to make space for GAIL, a utility defensive and value pick with imminent trigger. He also says they have added Eicher Motors, a premium urban consumption and GARP play to get exposure to the growth in the auto sector. So two stocks, GAIL and Eicher Motors on their list.
All right, Sridhar Shivaram of Enam Holdings is also weighing in. He says the first half of the calendar year 2023 will be tough for equities. He says the macro numbers look challenging and protection of capital should be the mantra. Their view is that inflation will remain higher for longer, both in India and the US, and they expect 25 to 50 basis point rate increase in India. Hence, he says it would be prudent to be cautious.
Okay, so that's a cautious view coming in from Sridhar Shivaram. But let's get you some money market views as well. Parul Mittal Sinha of Standard Chartered says the dollar INR traded in a narrow range last week amidst upward move in the US dollar and higher US rates. She says $83 continues to be a psychological resistance and she expects the 82.25 to 83.25 range to hold. She says hawkish FOMC minutes will weigh on Forex and further moves would depend on global data, especially from the US amidst range-bound crude oil prices and sharp narrowing of the current account deficit in Q4 of FY23.
On bonds, she weighs in. Parul Mittal Sinha says global yields continued their up move on repricing a further Fed rate hike expectations, buoyed by hawkish FOMC minutes. She says in line with the rise in global yields, domestic yields have also inched up. Her view is the 10-year benchmark bond yield is expected to trade in the range of between 7.35 to 7.45 next week. She adds the MPC minutes were hawkish, in line with policy statements with no explicit guidance on future actions. However, she assigns a greater possibility of a hike in the April policy.
All right, we have a lot of stock-specific action that we'll be tracking for you and get to that in just a bit in our special Top 10 segment. Well, we have Gujarat Gas, Mahindra CIE, Crompton Greaves, HE Infra, Lemon Tree Hotels and Sandur Manganese. They are stocks on the back of positive news flow. On the flip side, you have Sonata Software, Z Entertainment, Orient Cement as well as Delivery. They are stocks that could open up in the red.